It's Monday, August 11th, 2025, and the U.S. economy is buzzing with big headlines. From inflation concerns and investor jitters to job market warning signs and global trade tensions, we've got it all covered. In the next 10 minutes, we'll break down what's driving the markets, how it's affecting your wallet, and where things could be headed next. Let's start with one of the biggest stories. Tariffs are back in the spotlight, and they're already hitting prices. A new Reuters poll shows economists expect long-term U.S. Treasury yields to rise, with the 10-year possibly climbing to 4.30% because tariffs are fueling inflation and the government is issuing more debt. Goldman Sachs says consumers could soon bear up to 67% of these tariff costs, up from just 22% earlier this year. That means everything from laptops to household appliances could get even more expensive. The inflation impact? An extra 0.66% on core PCE inflation by the end of the year. Meanwhile, the job market, long seen as the backbone of the economic recovery, is flashing warning lights. Moody's Analytics reports that more than half of all U.S. industries are now shedding jobs. This pattern has shown up before almost every modern recession. While unemployment remains relatively low, the breadth of job cuts across manufacturing, retail, and even some tech sectors are raising eyebrows. The big question, is this just a healthy cooling off or the start of a downturn? Over on Wall Street, investor confidence is shaky. According to Bank of America's latest fund manager survey, 91% of investors believe U.S. stocks are overvalued, and 70% expect stagflation, that nasty mix of high inflation and slow growth. As a result, many big portfolios are shifting away from U.S. equities toward emerging markets, global stocks, and even defensive sectors like utilities. For everyday investors, that can mean more volatility ahead and possibly more cautious corporate spending. So what does all this mean for regular Americans? For one, higher prices on imports mean your next electronics purchase, from a smartphone to a washing machine, could cost significantly more. Higher long-term interest rates could also push up mortgage rates, making home buying even tougher. And if job losses continue to spread, we could see slower wage growth and a hit to overall consumer confidence, which are both critical for economic growth. It's not all bad news. Economist Nouriel Roubini, known for his often pessimistic outlook, is offering a rare silver lining. He says America's tech leadership, especially in AI, clean energy, and semiconductor innovation, could provide enough growth momentum to offset some of these policy headwinds. In other words, while the road ahead looks bumpy, there are sectors that could still pull the economy forward. Looking ahead, all eyes will be on consumer spending data due later this week, which could confirm whether Americans are pulling back on purchases. We'll also be watching the bond market, particularly the yield curve, for signs that investors believe a slowdown is inevitable. And of course, any new trade or tariff announcements could instantly shift the inflation and market outlook. The U.S. economy is walking a fine line between resilience and recession risk. Tariffs, inflation, job losses, and cautious investors all add uncertainty, but innovation and global competitiveness could still tilt the balance. Stay tuned, stay informed, and don't forget to hit that like button if you found this breakdown useful. I'll see you in the next update.